to talk about something that's going to affect a lot of you guys.
We definitely should introduce ourselves. My name is Pablo Vadillo.
Hi. I'm Natalie Moles.
I'm Jamie Giarratana.
And live life by design. The Federal Housing Finance Agency changed the rules. As of yesterday, there are new mortgage rules for borrowers.
More new mortgage LLPAs, which is pricing adjustments for borrowers that are purchasing for within the Fannie Mae or Freddie Mac.
Okay, let's go back. What does LLPAs for the people that are new?
LLPAs are loan level pricing adjustments, and you might not see them as a buyer, but they're adjustments that get embedded in the interest rate based on certain facets of your purchase, whether that's your credit score, down payment, all of those things get adjusted in pricing based on those parameters.
Yeah, so the biggest change, of course, and something that we're totally here for, is this is supposed to help equalize the loan process, right? So we all know that in the past, there's been a lot of disparagement between races, between the different classes, as to who has access to these loan programs. And don't get us wrong, this program is well-intentioned. At the same time, we don't necessarily agree with the way they've kind of gone about it.
Yeah, they're definitely, impacting people with middle to moderate credit scores.
So you mean they're punishing people with good credit scores?
Correct. So if you were just in like the middle, so say 720 or 740, and you're putting normal down payment with 10%, 5%, 10% down, you're going to have a much higher interest rate than you did before. And you're going to be paying less if you have less down and you have a credit score under 680.
So you're basically saying somebody can go shopping with their credit card, tank their credit score a little bit and still do okay in buying a house?
Well, what we're saying is if your credit score is now under 680, right? That's where I lived for a long time. And so let's use me as an example, right? So my credit was not great. My credit is much better now. And what you're telling me is that under this new program, because I have taken over the last 3 years to improve my credit, I'm just at that 720, 740 cusp. I would now be punished because I didn't leave my credit under 680.
I don't quite understand why they did this, to be honest, because it just doesn't make any sense at all. I mean, if you're over 780, no harm, no foul. But you have to, the 780 credit score and above, that's like spectacular credit. I mean, people in the moderate credit shouldn't be punished for having decent credit.
I agree. It's definitely harder because so many people try to pride themselves on paying their cards and their cars, everything on time, just to better their credit so they can get the better interest rates.
Yeah, benefits, essentially.
Yeah, and so this is a little hurtful.
But you're just building your credit, right? Where you haven't necessarily done anything wrong, but you might have a 660 score because you only have one credit card and you've only used it twice.
I guess that's great for college students, right?
Yeah, there should be an equal playing field, and people with decent credit shouldn't be essentially punished.
If anything, they shouldn't have taken it away from the people with the good credit scores. And
I agree.
And I'm sure they can just remove some free coffee or some lunches from the White House, and it probably can cover a lot of this stuff. I mean, just saying, where's all our tax money?
It's just really creating a bigger gap between the people that have you have to have a really, really high credit score or a low credit score. All the people in the middle are really unfortunate.
Yeah.
And I think that is really what creates the big picture, right? Because ultimately the ones with the really great credit scores are going to go relatively unaffected. At the bottom side of the scale are going to be affected.
Positively be
affected. They're going to reap the benefits. But now it's the ones in the middle that are having to bear the brunt.
Right.
There could have been a better solution, at least I believe.
Yeah.
When we're looking at LLPAs, the pricing adjustments, as let's say a borrower that has a 720 credit score, they're going to be quoted a certain interest rate. They're not necessarily going to see the LLPAs on that interest rate embedded in the rate. So they don't necessarily have to come out of pocket for the rate. They're not paying discount points. They're not paying points for the rate, but they're going to pay higher cost in mortgage payments on a monthly basis due to them being within that certain bucket.
And also with the way the interest rates have been rising up, that just hurts our pocketbooks even more. So I don't know why they would want to do this.
And if you're asking yourself, well, who is this going to impact? We know that nearly 60% of all new mortgages are going through Freddie Mac. So if you're a borrower from one of those financial institutions, which 60% of all home buyers are, you're going to be affected.
Okay, the reality is it's there. It's probably not going to change. So ways that you can help strategize that as realtors and as lenders is if you are within that bucket, any way that we can negotiate purchase price, seller credits to help with any type of interest rate buy downs. During this time period, we are here as your advocate to help you get into, a monthly payment that is fitting for you.
So I guess that would be a good selling strategy as a seller, giving a buy down credit.
A buy down credit, closing cost credit, repairs.
Or, there are grants out there too, like being educated and working with agents and lenders that are aware of the grants that are available out there for first-time home buyers to help with closing costs could go right into paying your rate down. So, the reality is this is what we're dealing with. So we just need to figure out how we can, make it better.
How does the math work?
So, for example, beginning yesterday, a buyer with good credit score of 750 that puts 25% down on a, let's say, $400,000 home would now pay 0.375% in fees on that 30-year loan compared to 0.25 or 750 under the previous fee rules. We're talking about a difference of about $400 in the grand scheme of things, and that $400 can really help somebody else out and make that financial dream possible.
Mm-hmm.
At the same time, you're kind of biting at the wrong person here, I feel like.
According to the FHFA, the new rules will redistribute funds to reduce interest rate.
As an example, a buyer with good credits, 750, puts down 25% on a $400,000 home, is now going to pay 0.375% in fees on a 30-year loan, which comes out around $1,125 compared to 0.25% that they would have been paying under the previous fee rules. Now, a buyer with a lower credit score, one of 650, that same 25% down payment on that same $400,000 home is now going to pay 1.5% in fees, or $4,500 versus 2.75 that they would have been paying before. We're talking about a $400 difference versus a $4,000 difference, and then they're taking that $400 difference and applying it to that $4,000.
Let's bring it back to the Bay Area. Our homes are not $400,000.
They are not.
So if we bring it back to the Bay Area, where I think San Jose's median price right now is 1.7 million, that's going to affect the pocketbook quite a bit more, right?
Well, I think that there is something to say too. Like these pricing adjustments are only for Fannie Mae and Freddie Mac. They're not for the jumbo investors. So loans for Santa Clara County is a maximum of $1,089,000.
Okay.
So if you have a buyer that's looking at 1.7 and 1.8, you're not going to be in these loans.
People are under the assumption that it's going to affect everybody.
No, it's going to affect 60% of buyers. So if you are in the Bay Area and you are looking to purchase a home up to around $1,089,000, you will be impacted by this. Is this a good thing? Is what we're
I mean, I think it's definitely more affordable for people that may have had, a situation in their credit. And I will tell you, of all the applications I've taken, I've never ever come across someone with bad credit that didn't have a reason. So, there's life events. So I see that side of it, but I don't agree that the people with middle to average credit should be penalized.
While I think it's a good solution to help people who may not have the opportunity to qualify otherwise, it's still not addressing the issue at hand, which is there's still not enough home sellers. There's still not enough inventory out there to meet the demands of the buyers that are out there.
Right.
Well, I think it's going to help some people out, especially people buying their first starter home. I think they could have done this a little bit better and thought this process through before just rushing it out.
There's definitely different solutions that they could have taken. At the same time, when it comes to politics and when it comes to these types of things. It's a wait and see kind of thing. At the end of the day, what we have to ask ourselves is this a good thing? Is it good for the market overall? It's still a toss up in my book.
We'll just have to wait and see, unfortunately. Hopefully it'll help. I want to be hopeful about this whole situation.
Yeah, and if you're watching this and you're thinking I'm going to tank my credit score in the hopes of getting a better deal, don't do it.
No.
Being a borrower with strong, good standing credit is going to reap many more benefits
Right.
than that $400 penalty and
And
$100
to
difference.
reiterate too, to our jumbo market, like in most cases, this may be your first house, but you're going to need a good credit score to get into the jumbo market.
And I think especially since we were talking the week before about doing FHA loans and house hacking, this might affect some of those people a little bit more.
Mhm.
Absolutely. Thank you guys so much for joining us. This has been another episode of Live Life by Design. If you guys have any questions about what is going on with the current markets, the different programs, myself, Natalie, and Jamie are all here available to answer any of the questions that you guys may have. Live life by design. No.